Yeah, we're going to do a session today on the average true range. And what I wanted to do, I don't use the average true range. And there are certainly those here at StockCharts that do. One that comes to mind is Dr. Alexander Elder. So I would highly recommend, if this is something that begins to interest you or piques your curiosity, you may want to check out his books because he does use this in terms of guiding him in his trading. So that would be one person to follow for sure. The average true range was first developed by J. Wells Wilder back in the 1970s to measure volatility. So he featured it in his 1978 book, New Concepts in Technical Trading Systems. So that's a book, I think, that also looked at parabolic SAR, RSI, and maybe one or two other technical indicators that were considered in that book. So that's another book maybe that if you want to get more information on this, you may want to take a look. When we talk about average true range, the first thing you have to do is calculate the true range. You can't get an average of something until you actually have the individual data to average out. So the true range, and I just pulled up Trade Desk as an example here. I want to go through some definitions first because I don't use any technical indicators unless I understand how they're calculated and what they mean and what their purpose is, because otherwise you just have lines on a chart. And that, to me, is not a good idea to trade off of just based on this line points this way, this line does this. If you don't understand what the lines are and what's going on, I really think that's a big mistake. So we'll go through and talk a little bit about some of the concepts, some of the topics, some of the definitions, and then we'll talk about the practical application and use of the average true range. Okay, so true range. If you're looking at the true range, ideally what we're trying to do here is to identify a form of volatility by looking at the range of a stock's, in this case, daily volatility, looking at the highs and lows, and just tracking that so that we have some foundation as to the typical range for a particular stock. So the true range is calculated by using one of these three calculations, and it's the highest of the three. So we either take the current high. So if we're looking at today, if we were looking at this, we'd look at today's high less the current low. So what's the spread in today's candle? Or we would compare the current high less the previous close. So we're looking, and this is based on absolute value. And the reason that we're going to talk about absolute value is Wilder didn't care which direction prices were going. That had no bearing whatsoever. All he was interested in was what the volatility was, what that range was, the true range. So we take the current high less the current low, or the current high less the previous close, or the current low less the previous close, to determine, and those last two, again, based on absolute values, to determine which one of these three is the highest. Now, when we look through candles, for the most part, I'm going to say that number one up here is going to be the calculation. Usually, it's going to be the distance between today's high and today's low. If there are no big gaps, it's almost always going to be the distance between today's high and today's low. Where you get into a day, I've circled this candle here. You see this huge gap up? Now, if I looked at the true range and just calculated today's high and low, I would look at 200 down to 173, and I would say the true range for this day is 27. But what if I took the current high, today's high, from the previous close? So now from 150 to 200 is 50 points. That is higher than the 27. So when you get these gaps, chances are, well, not chances are, when you get these gaps, the true range is going to be calculated from the prior day's close. Very important, because Wilder did consider where we were yesterday versus where we're trading today, kind of a thing. All right, so you go through this calculation, and you need 14 days of these true range individual daily calculations. And again, this is a daily chart. You can use the ATR, the average true range, on an hourly chart. You can use it on a daily chart. You can use it on a weekly chart, a monthly chart. And I would say it's based on, and this is just my opinion, my interpretation, but it's based on the type of trader you are. If you're a long-term buy and holder and you're using ATRs on a 60-minute chart, I don't understand why. That wouldn't make any sense to me. And likewise, if you're a day trader and you're pulling out the monthly ATRs, don't really understand it. You need to have it set up to coincide with the type of trader and the type of trading strategy that you follow. All right, so what is the average true range? If this is the true range, if taking these numbers individually is the true range, what's the average true range? Well, the default on StockCharts, if you pull up the average true range, and I'll talk about this a little bit more, but you'll see up here, ATR and in parenthesis 14, that's the default, 14 periods. So in this case, 14 days. And what it does is it looks at the last 14 days true ranges, adds them up, divides them by 14. And that's where you get this 8.466. It's from looking at the last 14 days and calculating the true range based on what we just talked about, dividing by 14. That's how you'll get that number. Now, obviously, the period starts, the first day of the period is actually based on the current high versus the current low. So you have to have a beginning. And so the beginning is just simply the first day's high versus the first day's low. That's your first day of true range. The ATR is the true range for 14 periods divided by 14. And then Wilder went a step further and smoothed it out a little bit by taking, when you go to calculate tomorrow, you're going to take the average true range for 13 days. And this should actually be true range, not ATR. But you add the current day's true range to it to give you a 14th day, and then you divide by 14. So that is how you're going to go through and you're going to make these calculations. Now, if you take a look at it, I mean, just eyeball it. And again, I like to try and figure out how these things work. When you get into periods where you're going sideways, and again, this is a volatility measurement. So when you're going sideways and you're not really doing a whole lot, here we move up a little bit. But really over this period, you can see that the volatility is nothing like during these bigger moves, or certainly a huge gap up like that, or these two candles. And so what happens when you get into these periods of consolidation, as you would expect, that volatility comes down. And here the ATR is dropping. It's dropping from, at this level, it was at 8.5. 2-3 weeks later, it's down to about 6.25. And the reason? Well, we're going into a less volatile period. So hopefully you can kind of see. And then once we start moving back up, then you can see the ATR starting to pick back up again. And then finally you get a big gap up like that. You can see the jump, the big spike in the average true range. All right, so hopefully you kind of, got some of the basics about true range and average true range from just looking at Trade Desk. Another thing you want to keep in mind, if you're familiar with MACD and PPO, you know how the MACD you can is calculated based on the dollar difference between two EMAs, and the PPO is based on the percentage. So MACD is, you can't really compare the MACD of Google to the MACD of Sirius or Sirius XM Holdings. And the reason is because their prices are so much different. Well, the ATR is very similar in that regard, in that it's based on the prices of the stock. It's not based on a percentage. It's based on absolute dollar values. So if I'm looking at Trade Desk, which is a $200 stock, I can't compare the ATR, the volatility based on ATR, to say a $2 stock. What $2 stock is going to have a $9 range? None, obviously. So again, you've got to be careful with the ATR that you're not comparing volatility by simply looking at the ATR between two securities. Let me give you an example. First, we'll pull up Booking Holdings. Booking Holdings is currently almost an $1,800 stock. So when you look at the ATR for 14 days, you can see that it's gone over the past 3 months anywhere from about 35 up to 60, actually a little above 60. Well, a $2 stock isn't going to have a range like that. I mean, no stock, unless it's in the hundreds of dollars, is going to have an ATR, an average true range like that. So I also pulled up Sirius just so you can take a look here. And you can see Sirius being a $6 stock. Look at what its ATR is. A little over 12 cents, 12 and a half cents. So just be sure you're not looking at the volatility between two different securities by using the ATR, because it really is comparing apples and oranges. Hopefully that makes some sense. All right, I'm going to move on now, and I'm going to talk a little bit about the Chandelier Exit, because I know Arthur writes about the Chandelier Exit. He's been on our show and he's talked about it before. But the Chandelier Exit is based a lot on the average true range. So I'm going to go through and do another definition here of the Chandelier Exits. Try to bear with me. But essentially what a Chandelier Exit is, what the purpose of the Chandelier Exit is, to try to allow a trader to stay in an uptrending stock on the long side based on certain volatility parameters. So if you know you have a volatile stock, you want to use that ATR to your advantage to set a Chandelier Exit, which is basically a moving trailing stop, if you will. But let's go through this calculation, and I hope maybe you understand a little bit better. A Chandelier Exit uses a 22-day ATR. So you can see the ATR up here, 22. I specifically put that up there because if you look at the Chandelier Exit, and by the way, Chandelier Exit you can find as an overlay, whereas average true range is going to be an indicator. So that's where, if you're looking down here under indicators for Chandelier Exit, you're not going to find it. The Chandelier Exit, as you can see, is literally an overlay, kind of like a moving average. So the Chandelier Exit is based on, and this is the default, the 22-day high, because again, you're looking at a 22-day average true range. So you're looking at the highest point in 22 days, and you're subtracting that 22-day ATR times 3. That's the default setting. That's the 22 3.0 that you see there. So if we actually went through a calculation here, and I used Bank of America as of yesterday's close, so my numbers wouldn't get thrown off by using an intraday chart and having it change. So based on yesterday's close, if you look at the 22-day high on Bank of America, right here we got up to 29.96 yesterday. So 29.96 is and you can see that's the highest it's been over the last couple of months. So that's my 22-day high. My 22-day average true range is right here, 0.556. So again, based on the true range, remember how we calculated that, you're looking at each day, you're looking at the current high versus the current low, or if it's higher, you're looking at the current high versus the previous close, or the current low versus the previous close. Okay, and whichever one's higher is the average, is the true range for that day. And then you take 22 of those calculations, take the average, and that gives you your 0.556. All right. Now, what the Chandelier Exit is doing here is it's taking the high price within your 22 days and it's subtracting 3 times your ATR, or 3 times this 0.556. So there's your 22-day ATR. Here's your 22-day ATR times 3, 1.668. And then your Chandelier Exit takes that high, 29.96, and subtracts 1.668 to give you 28.29. And if you look at this blue number right here, that's your 28.29. So this is how you calculate that Chandelier Exit. And again, the purpose is to try to give you a little bit of room based on a stock's volatility, to give it some downside room so that you don't exit too early. Now, what I find when I look at this is that the Chandelier Exit might be a secondary indicator for me. But if you followed me here on Market Watchers Live or in my blog or over the years, you know I'm primarily a price volume trader. That's my number one. That's my primary indicator. So if I use something like Chandelier, it would be more of a secondary indicator. And the reason I say that is I've got this Chandelier Exit overlay here on Bank of America chart. And based solely on my support levels, based on price, I would be looking at this gap up and this pullback intraday as my key support zone. And you can see each time we've come down here, we've tested this area and we've held. So without the Chandelier exit, that's what I would be looking at as my major support. And as long as I held that, I would be okay holding the stock. And now we've moved higher. Now, the problem I have with the Chandelier exit, though, is that now if I were to move back down, and perhaps the Chandelier exit would move down with it, I'd have to go back and see. But I think I'll give you some examples where it doesn't hold. But in this case, what if we moved below the Chandelier exit, but we didn't move below price support? What would we do there? Would we exit because we're losing the Chandelier exit? Would we go ahead and follow that trailing stop? Or would we stay in it because it's holding price support? And I know you've heard us talk about on the show, and others that come on the show, analysis paralysis. And this is why I limit the number of indicators I have on my chart. Because if I were to put the Chandelier exit on here and I see it go below the Chandelier exit, but it's still holding my price support area, I would begin to question, okay, this tells me to sell, but my price support tells me to hold. And then I'm going to look at the PPO, and maybe the PPO is going below the center line, so that would be telling me to sell. And then maybe the RSI is just above 40, which would say hold it. You can kind of start to see how different indicators start to give you different opinions. And what I think I would do, and I don't know, I'm just trying to be honest, I think I would begin to pigeonhole some of my stocks and say, well, this tells me to sell, but I got two things that support holding. And I would start to probably head more into that analysis paralysis mode. That's why I try to keep things as simple as I can for me and what works for me. And that may not be at all what works for everyone else. But I think the point here is that the Chandelier exit, I think, is a great strategy, a great technique. It's a disciplined approach. There's no judgment involved. We have exact numbers that we're following. But Chandelier exits don't take into account any volume. So if you're a volume trader, what if we came back down and we went just below the Chandelier exit, but it was on very light volume and we're holding price support? I don't know. What do you do? For me, I would probably not pay attention to the Chandelier exit. But it's designed to be very disciplined to take you out of positions when it fails. So anyhow, I just want to point it out that you're going to have other indicators on your charts, and the Chandelier exit may play a role for you. It may be a great addition to your arsenal, but you do want to be careful because it can create something that is conflicting with other parts of your technical analysis, and you just need to be aware of that. And be aware that it is a mechanical formula. It is a calculation. There's no bias in here whatsoever. It's strictly based on the actual numbers on the chart. Now, the reason for the 3, by the way, ATR, if you want to give a stock a little bit more room, then you want a higher multiple of your ATR. If you're much more disciplined and you want to see a stock going up, and if it starts to give you any kind of movement to the downside, you might want to cut that to 2 or maybe 1.5. 1, you're probably going to get stopped out a lot. And even 1.5 or 2, you're probably going to get stopped out a lot. But again, it's up to each individual trader. I can't tell you what works for you or what you should use. I think it's up to each individual trading strategy. And I would put it on the chart and maybe paper trade or just kind of watch it for a while before you use this as part of your trading strategy. All right, so let's take a look at the ATR and the Chandelier exits on a weekly chart. And I went back and I looked at Apple and pulled up Apple over the last 5 weeks. So now I'm not looking at daily, I'm looking at weekly. And so the ATR and Chandelier exits can be and often are used on charts other than daily. This is a weekly chart. So again, someone who's looking at a big picture doesn't want to get stopped out by the daily swings that we see from time to time, wants to look at this more of a daily basis, or excuse me, on a weekly basis. So here you can see 2014, Apple continues to trade above this Chandelier exit, which is based on 3 times the 22-week ATR. And we wouldn't get stopped out until right in here when we broke down. So you can see all these successful tests of the Chandelier exit without actually breaking down. So you can see where you'd probably hold this a little bit longer. But here's your breakdown. Well, it got you out first close below here got you out, probably would have saved you quite a bit to the downside, maybe 20% further drop. And then it went sideways for a while and really didn't start trending higher until a year and a half later. So I think that the Chandelier exit would have worked beautifully there for somebody longer term. Now, as we start moving up again, you can see the Chandelier exit going with it. So if you're back in and you're trending higher, you're just riding along. Chandelier exit doesn't tell you to get out, so you just stay with it. But look at what happens here. Back in June of 2017, we went just barely below. Now, here we went barely below, and it was a good decision. Here we went barely below, and look what it did. You'd been pretty upset. Stock went from 140 to 160 in about 2 months after you would have gotten stopped out using the Chandelier exit. Same thing here. We have 3 rough weeks. We go down. And what I'm noticing here is higher lows. So if I'm looking at this chart, I'm not really upset with it, but Chandelier exit has told me to get out twice, and they didn't work. So again, nothing in technical analysis is going to work perfectly every time, and you have to take that into consideration. You have to understand that this is a mechanical formula. It's there to help provide you some discipline in your trading, but it is not the answer every time. And you might say, well, maybe I'm just not using enough. Maybe I need to have 4 as my ATR. Well, if you're using 4 times your average trading range on a weekly chart, because remember, as soon as your stock starts to go down, the Chandelier exit's going to go down with it. So sometimes it's just going to ride down underneath your price if you give it too much room. So it really is an art trying to decide where, based on your own trading style, where to put that Chandelier exit and how to use it, what calculation to use, how many times the ATR. But here you can see outside of those 2 breaches, we actually continued moving higher, and it wasn't until November of 2018 that we had a big drop. And by the way, Chandelier exit, I'm talking about it from a long perspective, but when you get into a stock that's on the downside and it's below your Chandelier exit, that becomes your trailing stop on a short trade. So it works in both directions. Remember, the Chandelier exit is based on the ATR. The ATR doesn't care whether it's going up or down. It's absolute value. So this is not the direction of the Chandelier exit is not necessarily telling you that you should short it when it rolls over or that you should go long when it goes up. It is simply trailing the overall trend based on however you set up your parameters. All right. So I wanted to give you an example. So here's 1-800-Flowers. And currently, obviously, the stock got the upgrade, gapping up today. And I'm doing this also on my relative chart. So what I did is I just made the assumption, okay, let me pull up my relative chart on 1-800-Flowers, and let me put the ATR in here, and let me put this pink line in, which is the Chandelier exit, to just give me a little bit of an idea of what I might have, what I might have done or be doing. Well, one thing, it would have kept me in. I would still be in it right now instead of taking my profits. So that would have been a good thing because it is disciplined. As long as it keeps going up, it just follows it and goes along and tells you to hold. And you can see the Chandelier exit right now, 1742. Stock is trading at 1869. Are you comfortable giving it $1.27 to the downside, knowing that as price moves back down, your Chandelier exit is likely to move down with it? That's something to consider. But I pointed out this circle down here because this was a big day on 1-800-Flowers. Back in early November, huge gap up. This was with earnings. This was a big surprise when they came out and they beat their revenue and earnings expectations. Stock gaps up from $10.40 to $11 and then prints this huge candle. Now, if you followed the way I trade gaps, I'm always interested in the top of gap along with that intraday low to the downside. So 1-800-Flowers in December would have come all the way back down to my buy point. Well, as it was hitting my buy point, look at what it did with the Chandelier exit. It went below. So if I had gotten in somewhere over in here, the Chandelier exit would have been telling me to get out just as I'm hitting my primary support area. And so I would have been wanting to buy the stock. That may have kept me out of the stock if I, viewed this equally to price and volume. this may have kept me out of the stock because it's giving me a bearish signal. It's below the Chandelier exit. So again, you've got to look at all of this in context with your timing, your trading strategy, the period that you're looking at, the type of security you're trading. 1-800-Flowers is a smaller company. It's going to be extremely volatile. And you can see that with these huge moves in the ATR from time to time. When you get these big moves, look at that big gap up and look what happened to the ATR. So the ATR is going to still stay, quite a bit below price, but it is going to go shooting up with those big gaps. All right. I think I'm going to look at one more. Let's take a look at Monster. I don't know if I want to use this on a daily or a weekly. All right. Yeah, let's look at this on a daily chart. Now, you can see Monster, big gap up on earnings, big heavy volume gap up back in the end of February into early March. And you can see that we jumped up with the Chandelier exit just below the top of that gap. Now, it gets you out at $62, but now I'm getting back down to a key gap support and 50-day moving average on Monster, which I actually like. I think the stock looks much better here than it did when it was up at 66, just because I thought there was a lot of downside possible. But notice that the Chandelier exit did not hold it here. And as a result, we went down below, and it would be giving me an opposite signal of what I would be looking at if I wanted to trade this. If we get a reversal, we could get a hammer right at the right at the gap support. And that, to me, would be a pretty good signal because I can manage my loss to the downside. But again, Chandelier exit is not going to be providing that for me. So that is something, again, that we need to consider as we go forward. Now, maybe using the Chandelier exit in concert with some of the relative strength. Again, this is not something I've really looked at, but this is something that we could consider in our trading as we go forward. And I would suggest, when you go through and you look at any of the indicators, any of the overlays on stock charts, start out in chart school. One of the best ways, for instance, let me pull up this to show you. If I type in average true range into the search box and then show me all, instead of support articles, go to chart school articles. And here is average true range. Here's a great discussion of what I went over earlier, and actually gives you some of the numbers on calculating the true range. For instance, here's the high minus the low, and here's the high minus the closing price, and the low minus the closing price. Notice that the true range, the first 6 numbers, is always the high minus the low. The only time you get a different calculation is where you get gap ups or gap downs. But there's a lot more you can learn here. The other thing is the Chandelier exit. So again, Chandelier exit, chart school article. Click on it, and it'll go through exactly what we just talked about, showing you tables on numbers and so forth. So if it's still a little bit unclear what I went over, because I know it's a new concept, start talking absolute value, different, 14 days versus 22 days, daily, weekly, multiplying it by 3, 4, whatever. There's a lot of different complexities and different ways you can look at this. Go back and check out the article. I think the chart school is always there for reference if you have questions about any topic. So let's go ahead and pull up the summary slide. Some of the things we talked about, the definitions, practical use and application. It considers absolute trading ranges, not worried about the direction. We're just trying to see what the volatility is on a particular issue. It can be applied to any time frame. It is not a good idea to use it to compare volatility among different securities because, again, it's based on dollars. Higher dollar stocks are going to have higher ATRs. Lower price stocks are going to have much lower ATRs. And then finally, the Chandelier exit we talked about could help set trailing stops based on the ATR if that's something that interests you. Dr. Elder has been on the show. He talked about average true range a little bit. So if maybe you're still a little fuzzy, maybe today helped to explain some of that for you. But again, if this is something that you really want to get into, I would strongly recommend you take a look at maybe Dr. Elder's book, where he does discuss much more. And I think that is it.